And if we get just like I said, if we get a normal backup in the U.S. stock market, I'm looking for 50% drawdown. We haven't had that.
50?
Yeah, we've had two in the last since 2000, and that just gets us back to one-to-one GDP and the Buffett model you mentioned. Now.
Welcome back to Metals and Miners. I'm your host, Gary Boehm. Today, we're plunging into the heart of commodities, markets, and economic trends. I'm excited to introduce McGlone, Senior Commodities Analyst for Bloomberg Intelligence, with a sharp eye on global commodity markets and years of expertise analyzing trends in metals, energy, and agriculture. Mike's a trusted voice in decoding the forces that are shaping prices and investments today. Mike, it's a pleasure to have you back on Metals and Miners. Welcome to the show.
Thanks, Gary. It's an honor to be back on.
Wonderful. All right. So, Mike, let's begin with President Trump's copper tariffs. On Wednesday of this week, President Trump detailed changes that he's made to the copper tariffs that he's implementing, and copper had the biggest one-day drop in history. It took down all the metals and most commodities at the time. Is this a sea change, or is this just an aberration?
I think it's a sea change. I wrote about that a few months ago. I look at copper with complete respect for our viewers and listeners who do trade it and put on risk in copper. I used to trade and I don't anymore. I think I would have lost money trading copper this year, although I just have been waiting for this reversion. Everybody has, but it had to stop out the most people first. And the fact that you said we went down 20% in one day means it just ran through stops. So a lot of people got hurt. But the way I see it, this is a sea change akin to when crude oil peaked at 147 in 2008. I got that one right at the time. I thought it was the beginning of the end of the beginning of deflation, and I think it's similar with copper. Because first of all, it went up for a pretty severe aberration reason, the tariffs. We all found out that that was kind of obnoxious to tariff refined products, and now we know it's just going to be more like pipes and tubes and things. But that spread between LME traded copper and CME copper getting over 30% above LME, that's the highest ever. That's a pretty good enduring peak. Copper got to near $6 a pound. Right now it's at 440. Normal correlation factors in copper gets it to $3 a pound. And I do love when I get pushback on that, partly because I said, well, you look at iron ore and you look at it like a auto adjusted basis with copper's last 10 years, it's about the same price. Look at crude oil, it's about the equivalent of 350. You look at bond yields in China at 1.71%. All the indications are that's going to do what it normally does and head back towards 3. First kind of that being wrong would be staying above 450. Right now, as we speak on August 1st, it's around 440. And now we also see what's happened to the latest U.S. payroll numbers. The bottom line for copper, prerequisite for copper and crude oil, the most economic sensitive commodities to go up, is the U.S. stock market has to go up, and it looks like it put in a pretty good peak, at least for now.
What do you suppose the impact could be on silver, since silver is a byproduct typically of copper mining?
It's a pressure factor. So the silver's had a good run this year. It's popped up to near 40, but you look at it on a year-to-date basis, it's running parallel 27% with gold. That's a bad sign. Silver typically trades 2 times the volatility of gold. It's the devil's metal, leveraged gold for a reason, and it should be up double what gold is. On a one-year basis, it should be up double what gold is. It isn't. So most of the precious metals, gold, silver, platinum, palladium, have just been rallying on the back of gold. And now we're seeing that was with the stock market doing well and copper doing well. Now we're seeing copper probably rolling back over. And gold is, to me, the only enduring metal. I think this can keep going up this year, particularly if the U.S. stock market continues to decline, which is somewhat my base case. I have some indications for that. First of all, we're August. This is summer doldrums just kicking in. But you look at 30-day volatility on the S&P 500, it just bottomed about 7.2%. That's about the lowest in 4 years. And we're just kind of flipping over. And we had I think we're seeing a bit of a sea change in what's happening with sentiment in U.S. equities.
Okay, interesting. All right, so we have a K-shaped economy where the top 10% do almost 70% of the consumer spending. They own most of the assets. As long as their asset base is growing, they continue to spend and they get wealthier. But they could only spend so much on travel, leisure, fun, toys, etc. So then the rest goes into assets. As the K-shaped economy favors them more and more, they make more and more, but they can only spend so much. So the excess, like I said, it's getting put into the asset classes and it's driving these assets higher. Markets are at highs, gold's at highs, real estate's at highs, many assets are at highs, and other assets had been rising. Do you expect this paradigm to continue for the foreseeable future, or are you expecting something else?
Well, I really appreciate the way you walked into that question. By highs, let's define highs. The U.S. stock market to GDP right now and last year was the highest since 1929, if you put it on a year-end basis, the highest ever versus the rest of the world, and that's starting to back up a level. The highest in about 25 years of commodities, and the highest about 20 years versus gold. That was at the end of last year. Now it's all starting to revert. So that what you just defined was the wealth effect, and you also I nailed it. Top 10% of income earners in this country own 80% of stocks. There's going to be no way that they're going to really shut down inflation, shut down consumer spending basically, and shut down buying houses and condos in Miami until the stock market goes down. It's just there's only 2 times in history we've got similar examples in relevant history. 1989 in Japan. I started in business in '88, and my clients were Japanese. I remember that one well. And of course, 1929 in the U.S. So to me, this is what potentially has just started to revert as we speak now. And what's going to stop it? So to me, that's something I've been waiting for almost 2 years. I think it's getting started, but it's that reverse wealth effect. And the key thing is you get to a certain point where you lift risk assets so high, they just can't go up any higher. Have we reached that point? Now, people have heard me say this a few years before. I've pointed that out. Yes, I've said that too early. But one key indicator of that is you look at that gold to S&P 500 ratio. Gold's been outperforming the S&P 500 for a few years. If you look at gold divided by the S&P 500, those per ounces, it's popped up on a year-end basis to the highest since 2015. So gold's starting to take off. ETF holdings are kicking in, and central banks are still buying. So I'm still biased to gold outperforming the stock market. And to me, the key risk for everything is what you mentioned is when you get to 2 times GDP in the stock market, it is the economy. Now we've seen that. I'll give you an example. Last year, S&P 500 was up, what, 20% or so, $13 trillion, which was 40% of GDP. This year's correction was down about $13 trillion max. That's total market cap of stock market capitalization. It was about 20% of GDP. That's almost, I'm sorry, 40%. That's the most ever since the 20s. So it's all that matters. I think the Fed gets it. Mr. Trump, I think, has risks of having bad timing comparable to Herbert Hoover, who was elected in 1928 and started serving in 1929. And that's just the relevant facts of the risks of how expensive we are. The question is, will we revert? So I look at it, what you pointed out is you will not see a definitive decline in consumer sentiment and spending until the stock market goes down, and then maybe that started.
Okay, so let's just hone in a little bit on this. So, the markets have had a lot thrown at it over the last year or so. Contentious election, wars, tariffs, massive deficits, and so much more. Yet they've remained resilient. We've got massive budget deficits that are helping to contribute. There is very low unemployment helping to contribute. There's a lot of money flowing into the markets on autopilot. On the flip side, the Buffett indicator, all-time highs, PEs extremely elevated, concentration off the charts. So you have this paradox going on, but yet they have remained resilient. There are many that are calling for a blow-off top type move. Sounds to me like you're calling for a deflationary type move, maybe a dot-com bust deflationary, maybe a 1929 style deflationary. What are you really expecting here?
I think we got the blow-off top. I think July was it. My colleague Gina Martin-Adams, our chief equity strategist, pointed that mania we saw was probably near a peak. Question is how much longer it lasts. The thing that's different from the past is we didn't have things like cryptocurrencies. They're just completely massive, speculatively excessive. You have the 8th largest cryptocurrency, Dogecoin, worth $30 billion. It's just silly, stupid, expensive stuff. That only happens when you get near the peak of very expensive bull markets, and now it's just a question of normalization, and that's what I call it. And mean reversion can be a powerful force. 1987 was a mean reversion event. So to me, it's the macro kicking in, but also let's remember the background here. First of all, you mentioned the pretty substantial deficit spending, around 7% of GDP. Now that's significant. That's about $36 trillion or so. You divide that by the market cap of the stock market, and I think the peak in 2021 or so was 1.88 or so. We just got to near there. So as far as the market cap, the stock market, our deficit spending is very little. I mean, actually, if you take market cap divided by deficit, by the pure deficit, but that's the key thing that matters. It's just how expensive the stock market is. So I think we've reached that apex. Unfortunately, it's also happening in August, October. I just pointed out how volatile is very low. And I think one of the key indicators I've been watching is I have to go to cryptos, partly because we have a president who's completely tilted that way to help get him elected. And I've been looking at Bitcoin gold ratio as a great indicator forever. That Bitcoin to gold ratio right now, about 34 ounces of gold per one Bitcoin, has been flat since 2021. That's what, 4 years? That's not a good sign. It was a leading indicator of the stock market before. Now it's been lagging. So I think that this whole area is just ready for a bit of a reversion. Gold seems to get it. And all risk assets should suffer. Now, we saw copper drop recently for other reasons, but copper was not showing, it was showing pretty significance above 10,000, pretty significant resistance at $10,000 a ton on the London Metal Exchange. Looks like it's going to, London metals can trade lower. And then we have significant situations which happen in the rest of the world, facing unprecedented tariffs from the world's largest demand pull goods importer. And this was a quote today that I enjoyed seeing, didn't enjoy seeing it. I lived in France for about a year, about French wine industry might face $600,000 of job losses and $1 billion of profit losses from U.S. tariffs. And I lived there, and I remember they always charged about 20% in U.S. wine, and U.S. charged nothing in tariffs. I mean, that was just obnoxious. Like, sorry, but you had a great time. Should say thank you. Now it's just normalizing this disparity in trade flows, and that's a key lesson I learned in the trading pits in the 90s, in the 80s too, is that free trade isn't free. It's an aberration, and that was a book by Robert Lighthizer. But either way, the point is, these tariffs are going to shut down the rest of the world, push a major deflationary force. China spraying their deflation all over the place. You're seeing that in things like gold going up and crude oil going down. And now the number one thing holding everything up, the U.S. stock market, might have started tilting downward.
Okay, so let's say we do get this deflationary pulse that you're talking about. Do you expect it to be a 1929 style, crash? Do you expect it to be a 60s, late 60s, early 70s, more of a rollover and just an elongated, consolidation going nowhere? And are you expecting the Fed then to jump in and try to save the day, probably to limited upside potential, because they've already been throwing money at things over the years, and we know that the effect gets diminished each time?
Well, I think
where are you there?
I'd like to start with the Fed, because I think where you ended, I think that's very important, because the way I looked at it is the Fed cut rates last year, despite the U.S. stock market on a tear running that's very strong and near the highest ever versus GDP in the rest of the world. That was a mistake, and the bond yields told them by going up. Now they haven't had to stop, and I think they're finally they're not saying it, but they're getting it, that the stock market is the economy, and you can't really cut until it goes down and tells them to. Now it's starting to go down and starting to tell them to cut. I think we're starting that cat and mouse game where they're going to cut down to levels you see that's happening in Europe and in China, like I said, 1.71% 10-year note, and it's going to be an elongated process that might last for who knows for how long. Sure, there'll be plenty of stimulus, but we're at that game. Like I said, there's only 2 examples of this in history. Now, I don't think it's going to be a sharp correction, not as sharp as what happened in copper, but it's just a point of where we are. May we live in interesting times, and I've been accused of being a bit sensationalist. I'm just pointing out facts of what's happening, and then I point out pure deflation. Crude oil right now is down 50% from its high. It's down 6% on the year. That's a bit of a deflating asset. Corn is down 15%. That's the most significant agricultural commodity. It's down 15%. Why? There's an excess of supply. Why? Because prices went up to the peak in 2022, and everything's responding with elasticity supply. It's a wonderful thing about superabundance. It's kicking in. Now that's kicking in with copper potentially going down. So I look at it from a commodity standpoint. If copper breaks down like I think it will and should with the stock market, all the dominoes tumble like a normal deflationary cycle following inflation. And that was from the book, The Price of Time by Edward Chancellor. Just pointed out, it's one example, pointing out we always have these cycles. Good example is what's happened in Japan for the last 30 years, just coming out a little bit. What's happening in China right now. And they have to depend on fiscal deficits running 300% of GDP just to stabilize. And the rest of the world's having to push back on their exports that they can't export to the US anymore. So to me, this is a big picture macro. It's part of the reason I'm still bullish gold and US Treasuries. And I've been wrong for a while on US Treasuries, but not on gold. And I don't see what's going to push gold below $3,000 an ounce, but I see now the latest signal for it to get above 3,500 an ounce was this bottoming volatility in the stock market.
Okay, so we're going to get into gold in a moment, but President Trump, you talked about this in your answer just now, but he wants lower rates. He's been talking about wanting lower rates. You believe lower rates are coming, but Trump knows that there's greater than 10 trillion in bonds needing refinanced over the next year or so. That much is very clear. What outcome with a new Fed chair are you expecting in the coming months? And do you expect them to acquiesce lower rates? And when they do you expect this to have any effect on the long end, or is the long end completely separated and isolated from the Fed's ability to impact it?
I think Mr. Trump has put himself in a bit of a lose-lose position versus the Fed in the market, pushing back on Federal Reserve independence, a good factor that's helped create this massive premium in U.S. risk assets over the last 50 years up to the peak last year. Is a lose-lose. I mean, if when he does put in a new chairman, he'll be considered a lackey, probably cut rates. But the key thing is, what stage will we be by the time that happens in about 10 months in May? And I think it's going to be more the Feds already have started cutting rates because the stock market started going down and told them to, and maybe the new chairman will cut faster, but he'll get those rates because one thing that Mr. Trump knows, he's a very clever person. I do not underestimate this human being. And the best way, I think, to get yields lower on mortgage rates, which is a key thing he's been pointing out, is for the stock market to go down. And the key thing, remember, is 55% of the U.S. population, about 55% are wage earners. That's the population voted for Mr. Trump. They're not so exposed to the stock market versus the top 10% who don't really vote for him. That's the key thing to make it happen, and it's going to see how we happen by next year. But he's also set up a good fact of plausible deniability if and when the market just has a little bit of normal reversion. He can blame it on Mr. Powell. He will, but that's his nature. But the thing, you see the lose-lose there? It's a win-win for gold. And the point is, when you push back on something that's so ingrained in the importance of a first world country's proper management of the economy, it's not going to turn out well. So if he tries to do something with Mr. Powell before the end of his term, I'd say good luck with that one. The market's going to beat him up. But either way, we've already started that tilt towards yields going lower in the U.S., partly because look how low they are in Canada and the rest of the world, and in China and Germany and Europe. We're just catching up. And
where do you expect the long end to be if they lower, when they lower rates down on the short end? What are you expecting to happen on the long end?
Well, I think we're all turning Japanese. And China's at 1.7%. Long end right now is 4. Just the peak this year was 5.15%. That was almost the highest in 20 years. And that's about when Bitcoin peaked too. Now Bitcoin's below that level. You see what's part of the driver, risk assets. I think it can easily get back down to 2%, and that's long term. Or at least where copper says, and copper's going to 3%. I do love overlaying the dollar price of copper with that U.S. 10-year note yield. Right now, U.S. 10-year note yields, as we speak, are 4.22. Copper's a little bit above that. Copper got way too high, and they'll probably go down together towards 3 initially. But we have to see what happens with the economy and the stock market. And to me, now we're at that point where it's so expensive. The economy is the stock market. If we just have a little bit of a back and fill, that's your recession we're way overdue for. And this key thing I'm really concerned about is when you have a new person come in, say second term, and try to make the country great again when we're already at the highest valuation ever versus the rest of the world in terms of the stock market, and the highest in almost 100 years versus many other measures. The risk is he just tweaks a little bit of reversion. I think that's going to happen.
Okay, so in your scenario where the stock market goes down, and the stock market is also the economy, the stock market ultimately drives a lot of tax revenue. We already have a substantial budget deficit. How much can they stomach tax revenue going down? I mean, won't they do anything and everything to ensure that the market stays elevated enough so that they can capture enough tax revenue from it?
Sure, they have. That's my point. We've had the Fed starting this. We'll save the stock market every time it goes down with the stock market crash in 1987, and we know that's ended. The fiscal is pretty strong. We have kicked in with Doge. It's cutting back substantially, but we've reached a plateau that is historically never been exceeded on a long-term basis ever. So maybe it's different this time. I like to bet it's not. I look for signals to see if it's not different this time. I start with gold. Backing up. Right now, I'm looking at just my updated S&P 500. Gold divided ounces of gold divided by the S&P 500. It's jumped up to 0.54. That will be the highest if we end the year there. The highest since 2014. So to me, the point is we've reached the end game. Gold making record highs, just figured that out. And then we have one major area where it's so easy to define. We all knew in 1999 there was a major area to just tweak the bubble and purge all these excessive internet stocks. It's cryptos. I mean, it's just silly, stupid, somehow expensive some of these things are. Like Dogecoin, it's like number 8. It's worth $30 billion. It tracks nothing. Shiba Inu is worth, let me check the latest on that. It's worth $7 billion. It tracks nothing. So to me, that's what we're going to get. I think we're going to get a purge, and that sector is going to lead the way.
At least we could all agree that Fartcoin is worth something, right?
There you go. I mean, exactly. It's,
Okay.
Well, because just like you pointed out, it's worth the humor. But what's happening now is the thing I've really enjoyed writing about 5 years ago is when Trump hated cryptos is when I loved them and Bitcoin. And now that he loves them, I don't say I hate them, but we've pumped up to those levels. I like to go there because there's a leading risk assets on the planet. And speculation and hubris and everything, and all this tokenization makes sense. It's overdue. The whole space is going to the dollar. This de-dollarization is silly when you look at what's happening to cryptos. The whole world's going to crypto dollars or stable coins through the dollar, where the world can get access through the dollar through their phones. Never been able to do that before. But it's pointed out, as we tokenize all assets, you can get them on the chain, you're going to be able to arb out those tokens versus a real asset that has earnings, and be able to maybe sell some silly assets that don't have any earnings that are worth $30 billion and track nothing. It's just normalization. I think Wall Street, they're going to learn the hard way about Wall Street does to silly speculative excesses. And Wall Street's part of it too right now.
Yeah. All right. So, Mike, with AI, robotics, the electrification of everything, it's set to explode from a demand perspective in the coming years, and a lack of corresponding investment to equal that demand on the mining side, because everyone's been so focused on tech and some of the stuff you've been talking about for the last 15 years. Do you expect the metals and the minerals to be a bottleneck to growth of those things at some point?
I'm looking at the macro for industrial metals. The Bloomberg Industrial Metals Index is basically flat on the year now, with the S&P 500 up about 7%. That's a real bad sign now that copper's given it back. I'm always been concerned about the miners. Obviously, we've had a decent bounce this year, but if you look at in terms of the GDX index divided by GLD, it's been buried forever. It's bounced. But central banks are buying the actual underlying metal gold. And you just have to, when you look at any other metal but gold, which everything else but gold are industrial tilted, most notably silver is more industrial now than it is precious. You have to look at China. What's happening in China? Start with that 1.71 you know. What's happening with iron ore? It's stuck below $100 a ton for how long now? It's trading lower. I just don't see, and what's happening with crude oil, all these things, I don't see the upside for industrial metals, particularly if the U.S. stock market goes down in this case. I still look at gold as the best performing assets. And the bottom line, again, Gary, is I hate to keep going back to it, but I have to focus on, if you're running any type of money, any type of value at risk now, you have to know that if we just take back 10% on that S&P 500, that's all that's going to matter. It's all, and so far it's potentially starting to happen.
Okay, so you had pointed out on your Twitter, when it comes to the economy, it would be a good economic sign if copper stays above $10,000 a ton, but the opposite for gold at more than $3,500 an ounce. Based on your analysis of the economy and the Trump administration policies, which one do you expect to be more likely at this point? $10,000 a ton and higher for copper, $3,500 an ounce or higher for gold? And, is it possible both could be true?
Unlikely. I'm fully sticking with the rock beating stocks. I think gold's a matter of time to stay above $3,500 an ounce. The key thing I'll be publishing on Monday, about by the time this comes out, Monday, August 4th, is my outlook for gold to stay above $3,500 an ounce. Little trigger is that bottoming volatility in S&P 500. Man, I know it's August, but things kick in. early now, usually August, and I fully expect that $10,000 a ton resistance in copper to hold and go back down to around 8,000 or so. I think regular U.S. traded copper is going to go down around 3. Bottom line there is it has major companions: iron ore, bond yields in China, crude oil, and now potentially U.S. stock market. If that goes down, industrial metals are all going to get pressured, and most specifically copper. And copper, the key thing to remember about copper is it's not as autocorrelated as, say, corn, one of the most autocorrelated commodities there is, very elastic, or crude oil, which is becoming more autocorrelated. Price on the screen right now is the same as first traded in 2006, but it's becoming that way. If you look at copper just the last 20 years, the high recently was around 6. It's been hovering, the mean level has been around 3, and it gets down around 2. I think it goes back to 3. It's not a very profound thing to say. That people in the chat, IB chat, and metals chat this morning were messing with me, and I just pointed out, well, iron ore has done it, bond yields have done it, crude oil has done it. And yeah, I get your momentum's all, and that's the problem. When you see every single momentum indication up and you know people are overweight long, you just have to hit a few stops. And that's what copper just signaled to me this year, or just this week, by dropping 20% in a day. You hit stops, you go back and normalize. And that's not profound to call for normalization of a elastic, a highly autocorrelated commodity, and copper's there. Now you look at the fundamentals, you have to start with China. And what's the trigger for problems in China? The rest of the world is facing unprecedented tariffs from the world's largest goods importer. This is a 50-year paradigm shift.
Yeah. Okay. So in that scenario, copper going down to 3, you would expect supply to come offline, right? Okay. So supply comes offline, which also affects silver. Silver has been in deficit for 5 years. That means even less silver is coming online at the same time, with all the the electrification of everything, with the data center build out, the robotics, the AI. There's a lot of need for silver, but yet it's already in deficit. Is there a equilibrium point for silver versus the other industrial metals because of the supply issue?
Well, there you named it. That's called the low price cure. That's a lesson I learned from farmers. It's the most elastic commodities. We have to get to that low price cure. We're approaching that in corn and grains. We're approaching it in WTI crude oil. The cost of production in this country is around $55 a barrel. As we speak, it's 67. It hasn't reached it yet. You usually have to get below those levels to really reverse those excesses of supply versus demand. Where it is in copper, I say it's at least 3 to get and reverse those forces. But remember, copper's more industrial specific and related to, stock market goes down and hit copper.
But what about silver? Yeah,
and silver, the silver I still, but the key thing I'll point out is I do expect silver and copper to continue to outperform crude oil in the long term. Electrification, absolutely. 20% of silver demand is from EVs, not from EVs, but from solar panels.
Solar panels.
And I expect that to happen. But remember, it's just it's an industrial metal, much more every day. And that silver to gold ratio, when it peaked around 100, that's a pretty good peak. Right now with silver or gold, we're running around 80, 90.7. Silver is cheap to gold, I get that, but you need the stock market to go up for silver to outperform. And this is what's been different about silver. It's still underperforming. It's going to have the headwind. And if we get like I said, if we get a normal backup in the U.S. stock market, I'm looking for 50% drawdown. We haven't had that.
5-0?
Yeah, we've had 2 in the last since 2000. And that just gets us back to 1-to-1 GDP and the Buffett model you mentioned. Now, it's not going to be overnight, but that's a macro bigger picture.
How long of a period of time?
Exactly. I wish I knew. One thing I've learned in trading, and certainly as a strategist, is try to be careful putting time and price together. And I did say that at the beginning of the year looked good for a little while, and it looked pretty stupid until last few days. But to me, that's the macro that we have to be expecting to be tilting towards to the end of the year. If I'm wrong on that, which would be wonderful, then we'll reassess. But for now, I still expect gold to continue outperforming most risk assets, most metals, particularly silver, platinum, palladium, and copper, and treasuries, potentially U.S. Treasury bonds, to be the next big trade.
And your trigger for this deflationary impulse in the markets, the 50%, is tariffs. Is that what you're saying?
Yes. Well, that's what you need. So typically what happens when you get that expensive, you're just looking for a catalyst. Now, tariffs, I think, are part of it. It's a long-term thing. Just to point out, it's already happened twice in the last 25 years. People seem to forget that. But it's the key thing to remember about what happened in this country. I'm from the heartland. And when you're in the heartland and you shut down a local plant to to outsource supply for any type of, any type of product or widgets you're making. It's very politically incorrect, but you increase your profits. That's the bottom line. All capitalists are profit maximalists. They have to be, more so everywhere in terms of competition. But what's happening now is we're shutting down some of those profits. So key thing that I've learned from my colleague in equity side, Gina Martin-Adams, is about 40% of S&P 500 is earnings are related to imports. Now we're having a problem. We're going to cutting back on earnings there, we're triggering that, but it's also that deflationary force for the rest of the world. So yeah, that's a big enough trigger. And the bottom line, it starts when prices just get too high and stop going up. And that to me is where we are. The only thing that's going to trigger a recession in the US is US stock market going down. And you need that sentiment shift. It might have happened. This is early days. It's only August, but it's just lessons of history. You never want to be overweight risk assets when your stock market is 2 times GDP. You look for alternatives. I look at gold and I look at treasuries.
Does it make sense for an engineering, so to speak, of a recession and a market decline as Powell is leaving, and then engineering an uplift with a new Fed chair of Trump's choosing, and all hail the chief kind of a scenario?
It does. So let's look at what happens. Let's say, as things are right now, today, if Powell were to be fired and the new Fed chairman comes in and cuts 100 basis points day one, what happens to the bond market? What happens to the stock market? That's just debatable what's going to happen, but it'll be viewed as a complete lackey to the president, and the lessons we have in history is that doesn't work out good. It'd be like a third world country. It might be great, but now the thing is that's not going to happen. When we do get a new chairman, it's a question of where things are at the time. I fully expect by the time we get to next year, the Fed will already have started easing the easing process. And the key thing, remember, about any chairman is they will be thinking about their legacy. They might get in and cut right away, but do they want to go down in history as the idiot of history in terms of what, they want to go down like a Volcker, and they might, appease Mr. Trump initially, but they'll be thinking legacy. And I think that's what Powell's doing right now, but he kind of hinted at a potential environment where he might have to hike in his last meeting this week. But the bottom line is, this is, again, we're tilting back to that. It's a lose-lose, I think, for Mr. Trump. And I think he's going to find out the hard way that you can only jawbone so much. And you get risk assets just high. I'd say good luck. And I just look at prudent investors are looking for alternatives. So what I'm sensing is a lot of Americans are taking those very expensive dollars and those very expensive assets and diversifying elsewhere. And one of the key simplest ways to do that internally is gold.
Yeah. Well, this has been an incredible discussion. I really just want to welcome everyone who's tuning in to this fantastic interview with Mike McGlone, Senior Commodities Analyst for Bloomberg Intelligence. Before we wrap up with our final set of questions for Mike, I want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's also the name of the report. Now, I'm positive that you've been enjoying the conversation Mike and I have been having. Please hit that like and subscribe button and leave a comment below the video. Mike, before we started recording, we talked about an asset ranking lightning round. Let's finish off our discussion with that. We'll go real quick through each one. I'm going to ask you to give each asset a score of 1 to 100, 100 being an extreme buy, 1 being an extreme sell. Just give 1 to 2 sentences as to why you take that position, and we'll just try to roll through these real quick. All right, so as of right now today, on a scale of 1 to 100, is gold a buy or a sell, and why?
It's closer to 100. It's a buy. It's a bull market. It's been consolidating for 4 months. It's good fundamental reasons to go higher. And the number one reason for it to go higher, I think, could be a stock market going lower.
1 to 100, gold miners.
Don't really know. I suspect they're more bullish, but they'll be rallying on the back of gold, which is bullish. The thing I'm worried about is the stock market going down, but still bullish that whole space, and gold miners are part of it.
Okay, so what score would you give it?
Less than gold. I'd say if gold, I'm putting it about 70 or 80. We'll put miners closer to 50 or 60.
Okay. Silver, 1 to 100, buy or sell?
It's up there with gold. With the miners, I'd say 50 to 60. Silver's running up on the back of gold. The problem is it's an industrial metal, and I'm more correlated with copper. It's running up on the coattails of gold, and let's remember the main buyers of gold have been central banks, and they're not buying silver.
Okay, so you do expect silver to continue to
Yes.
at least stay in a range or go higher as long as gold is going higher.
Still bullish.
Yeah. Silver miners.
Don't really know.
Okay. Copper, 1 to 100.
Closer to, I would say, a 10 going lower. I'm bearish copper. I think I put an enduring peak at almost $6 a pound. Next trade, I think, is closer to 3. That's a normal autocorrelation thing for copper, particularly if the U.S. stock market goes down. And a key indication for me what's happening to copper is iron ore going lower, crude oil going down, and bond yields in China at 1.71% versus U.S. at 4.77. That's a 10-year note yield.
All right, let's shift over to energy and start with uranium.
I'm bullish, but don't really follow too much. I'd put that as closer to a 60 or 70. Just don't watch as much.
Okay. Do you make a distinction between the metal and the miners?
Not really. I just don't follow uranium that much. I hear about it. I love to watch Macro Voices, or Eric Townsend is quite bullish uranium, but it's not really in my space, partly because the bottom line for me is actively traded futures usually is really in my space. That's more my background.
Understand. All right, let's talk oil, 1 to 100 and why.
Closer to 1 going down. I think crude oil's prow is going to be around 40. It's not profound to say that. WTI crude oil's bottom around 40 3 or 4 times since 2008. Cost of production in the U.S. is 55. Right now, it's trading near last year's low, about 65, and the high is 80, and there's an excess of supply and declining demand, and rapidly advancing technologies pressuring crude oil.
So with rig counts also dropping and being at a low where they are, that's okay?
Rig counts hasn't mattered for 10 years. You have rig counts are the same as they were in 2010, yet the production is doubled. It's because of that rapidly advancing technology, being able to build laterals 4 to 5 miles. And the rig counts should continue. We should see a decline in production, but it's a lagging factor to price going down. It's that low price cure. We're heading there now, at least we just haven't trowed yet, I don't think.
Okay. Do you have a timeline estimate for your low price cure range?
It's been a lot more longer than I thought. After mid-year, I started talking about crude oil going to $40 a barrel when it peaked above 100 in 2022. Been way early, was considered an idiot for a while, but less so now. And I think a lot of it's going to depend on the U.S. stock market. If the U.S. stock market goes down fast, crude oil will get to 40 a lot faster.
I see. Okay. All right. Let's talk about the markets. We'll start with the NASDAQ, 1 to 100 and why.
I'm bearish. I think we've reached an inflection point where we've just got to the point this week where all the earnings are beating, yet the market started going down. It's classic what happens when markets get too expensive. I don't know how much lower it goes, but as far as the 1 to 100, I'd put it below 50, which is bearish. I wouldn't say how. I'd say about a 30.
Okay. S&P 500.
Same as NASDAQ. Again, we had earnings beating. Market put in a pretty good peak. It's heading lower. We might have had a sentiment shift. The volatility reached the lowest level, 30-day volatility in like 4 years. I think it's heading lower. And now the whole world's facing tariffs, which are attacks on corporate earnings.
All right.
So I guess that'd be about a 30.
Okay. All right. Thank you for that. Let's shift over to treasuries. We'll start with short term.
Oh, close to 100. I'm very bullish treasuries. I think it's just a matter of time the Fed has to cut. The U.S. 10-year note yield at 4.22 goes to where it is in China at 1.71. And it's the classic lessons of what I mentioned earlier. Deflation always follows inflation. And we're just starting to kick over that in the U.S. It's pretty severe in China. It's just a matter of time for the U.S. to catch up. Again, the bottom line for treasuries, yields going down, is U.S. stock market going down.
Okay. Let's say in your scenario, the 10-year does go down to the 1.7 range. What do you expect to happen with mortgage rates?
Oh, they'll plunge. Mortgage rates in the U.S. are running just below 7%. I don't think they'll get back to where they were right before COVID, maybe 4 or 5%. But that'll be a recession.
So will that unlock the housing market?
Sure. Well, the problem with the housing market is we're the highest prices to income ever. And the stock market's the highest ever to housing prices. It's just how expensive and silly stupid things get. So I think, things will unlock, but it's going to be a long-term process. But the key thing to remember is we have had a confluence of 100-year events, most notably this biggest money pump in history to the 2022 high. We had the biggest pump in real estate prices and asset prices. expect that to just alleviate itself overnight is unlikely, but I think there'll be a long enduring bottom and bear market for housing, risk assets, and questions how long it lasts. But yeah, interest rate yields will drop, but when people are, if unemployment goes up to 6%, which it always has, it's less likely, fewer people and with less money to be able to buy those homes.
So market drops 50%, housing drops despite the mortgage rate drop, housing prices drop on average. How far do you think?
Don't know exactly. Let's look what happened last time. Now that was 2006 to 2009.
Yeah, what was it, about a 25% drop?
Yeah, so we're overdue for just a normal 20% pullback. And remember, that would be well above where they were before COVID.
Yeah. Okay. Going back to treasuries, long-term treasuries, 1 to 100.
Close to 100. I think that's one of the best potential assets to go up. Admittedly, I've been saying that for 2 years, but it's going to happen with the way copper dropped. It'll just be an overnight phenomenon kick in, I think. And I think U.S. Treasuries are going to drop 200 to 300 basis points, maybe 200 basis points, and just catch up to what's happening in China. My lesson for that is what's happening in what happened in Japan. I traded JGBs 30 years ago, seen this before, and that's what's happening in China. And again, those are predicated. U.S. Treasury yields will go down with the stock market.
Okay. Inflation as a percentage ending the year, 1 to 10%. Where do you see it?
Lower. I think U.S. inflation will follow the stock market. That's what's keeping it up. So I'd say closer to 1. And U.S. inflation will tilt towards a period of deflation. We're way overdue. Remember what deflation is when you measure on a 12-month period? Way overdue for that. And I'll end with this. PPI, year-over-year PPI in China is minus 3.6%. We should see that here.
Okay. And 1 to 10 probability, 10 the highest, that we're going to have a recession by the end of this year, 2025.
If the stock market goes down, it's closer to 10. It's all about the stock market. I'm bearish the stock market, so I'm closer to a 10 on that.
Okay. And lastly, the recommended portfolio allocation has been 60-40 for decades, 60% stocks, 40% bonds. Very, very few financial advisors even recommend holding any gold or gold-related assets at all. Do you recommend a gold portfolio allocation? And if so, how much and where are you pulling it from?
Yeah, so I don't make recommendations, but I fully expect gold's going to continue to be one of the best performing assets. It's beating the stock market for, almost 10 years now, depending on how you measure earnings. And I think that's going to accelerate. So I think that gold to S&P 5 ratio is going to go back to 1 to 1. And it's way overdue for it. It's what it's done historically. So I'm still very bullish gold, but the 60-40 I think is so old. And remember what it is, 60-40 really isn't 60-40. It's really 10-90 because of the volatility you get in the stock market. And I think there's certain times you're supposed to be underweighting risk assets and certain times you're supposed to overweight risk assets. Now, COVID, when the U.S. pumped all that money in the system, that was overweighting risk assets. Now you're supposed to be underweighting risk assets, which includes that 60. And I think gold's part of what should be in the 40 part. And maybe overweight gold and treasuries.
Appreciate that. All right, Mike, thanks for coming on to Metals and Miners. You've been so generous with your time, analysis, and ideas. I always love our conversations. Would you let everybody know how they could find you, contact you, and learn about your work?
Well, thank you, Gary, on your program. I appreciate that. I'm on the Bloomberg terminal, on X at Mike McGlone 11, and LinkedIn. Just search for Mike McGlone, Senior Commodity Strategist at Bloomberg, and happy to add people to my distribution list.
Wonderful. I'm going to have all that information up on the screen. It'll be in the description area to click through. Mike, always appreciate it. Look forward to having you back on sometime soon. Everybody else, thanks for watching.
Thank you, Gary. Thanks for having me.
Everyone who's tuning in to this fantastic interview with Mike McGlone, Senior Commodities Analyst for Bloomberg Intelligence. Before we wrap up with our final set of questions for Mike, I want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's also the name of the report.